There is a lot of fear, there is greed.
It's not a lottery ticket we are buying. We are becoming a part owner in that business.
We all know that patience is always very short.
Only 23 invested stayed invested for entire stretch of 20 years and they enjoyed that 18% CAGR.
One investment rule which you would never break.
I think disturbing compounding is a sin in terms of wealth creation.
Last year we have seen a lot of exuberance in the market.
Investors' behavior makes well for them.
Mid-cap or large cap?
Mid-caps.
So how do you de-stress yourself?
It always pays to be an optimist in the market.
Hello friends, welcome to Ventura Spotlight. In this episode, we have with us Mr. Atul Bhole, a fund manager with Kotak Mutual Fund. Atul has over 18 years of experience in investment management and he has been managing an AUM of more than 50,000 crores with Kotak Equity Hybrid Fund and Kotak Emerging Equity as his main funds. So let's get started. Hi Atul, it's a pleasure having you with us on the show over here at Ventura Spotlight. So for many of us, watching you for the very first time, take us through your journey. So it helps us, to understand what goes behind a fund manager.
So to talk about my journey, actually, interestingly, I have not chosen this field. I came to this field by eliminating a lot of choices we always get into our education and careers. We had a professor, he himself in his individual category is a big investor in Indian market. So from there, I got the cue and got interested in equity research. And that's how I sort of came into this field. And over the years, after doing, say, around 10 years of equity research, I got into the fund management.
So where did you start your fund management from?
I started my fund management at Tata Mutual Fund. I worked there as research analyst for 5 years and also had got very good mentors there in my early career. And they gave me actually the break in the fund management from say 2011.
Oh, great. So how long have you been with Kotak Mutual Fund now?
Kotak is just about more than a year now. I joined in January 2024.
So, fund management, we understand that it's quite a lot of stress involved, in day in and day out. So what inspires you and what motivates you to keep on going every day?
I mean, maybe my personal thing, but I never felt it like a stressful job. When you have a passion for what you are doing and your intentions are all right, your intentions are honest, I think there is no question of stress. And we all know about the volatility or the ups and downs in performance. I think that is well understood fortunately, by the market people. So I don't think there is a stress. Obviously, there will be some kind of nervousness, but I won't call it stress. In terms of what drives me in terms of fund management, so in Tata, we had a trustee by the name Mr. Kishore Chaukar, you might have heard. So in one meeting, he asked us, all fund managers, a question that what gives you a high in your everyday activities? So obviously, being a novice, I couldn't think of a right answer. But when I thought later on, I thought that not just placing the buy or sell order or my stock going 5-10%, that doesn't give me high. I get the real high when a lot of people sort of put money in my scheme or funds on a daily basis. Obviously, they look at the organization, they look at the platform and give their hard-earned money. But there is directly or indirectly, I am also responsible for attracting that money. And that is a big responsibility and trust so many people are putting on us. So I think that is the thing which keeps driving me.
Okay, great. So, fund managers play a, key role in, creating wealth for investors. So what is your investment philosophy in terms of, how do you go about specifically when you're managing, other people's money?
Yeah, I would say we play some role in that wealth creation. The real role is investors. They have to play their role. We are like Rangmanch ki Katputliya. Things keep happening in economy and investors' behavior makes well for them. As far as my thought process of philosophy is basically, I believe that when you buy a share, like in Peter Lynch's words, when you buy any company share, it is not a lottery ticket. It is part ownership in that business. And hence, I would want to invest in companies where I'm comfortable with the business model. I'm comfortable with the people running that business. And obviously, the other things like growth and valuations, etc. But I would say I will give utmost importance to people driving the business and the business model. Unless I get confidence on both of them, there's no point in looking for the price or valuations and all those things. I think those things come much later. So yeah, I think the quality of management and quality of business, that's what I look at, and that's my guiding sort of pillars in terms of identifying any opportunity.
So that is more on the qualitative side, So and what should a retail investor, if he's looking at equity, how should he approach that with quantitative data also, which plays an important role because qualitative is very very subjective.
To a large extent, I mean, obviously this is subjective, knowing about the business and the management, etc. But I think I would always put this first, then the quantitative techniques, because investor can invest looking at a stock at a price, maybe absolute price, because the retail investor may or may not be aware of the concept of valuation, or even if he is aware, he will look for a low P stock or low price to book stock. But in that case, it can turn out to be a value trap. So I think when the retail investors are approaching the market or the individual stocks, I think first they have to look for a diversified kind of portfolio in case of stocks or mutual fund. And also, I would say they have to look at some point of time what they're buying. I think knowing what you are buying is very, very important. And that should be the first principle of investing.
And in qualitative factors, I mean, then can you give at least 2 or 3 examples which individuals can look at in terms of assessing that qualitative factor?
I think management or the people running the business, that is the first thing investor has to be sort of get confidence on. And the way to look at it is basically the track record of that management or people, what they have done in the past, how they have run the company, or if not that company, how they have operated in other companies or other organizations before this job, how they have managed the business cycles. We have the big learning, at least I have a big learning from 2005 to 2008 cycle, when the economy was doing very well, markets were doing very well. Even the great managements sort of became greedy and did some silly sort of acquisitions at very high prices, or they ventured into very big projects looking at the that time scenario. But obviously cycles keep changing. So how they have managed the cycle, business cycles, in terms of their greed and their fear, I think that is very important. In terms of slightly quantitative and plus qualitative is basically how the company has grown in terms of whether they have used the internal accruals. I mean, they generated cash from the business and they used it to grow it, or they have raised money from outside in terms of excessive debt or maybe equity dilution. I think excessive debt or frequent equity dilution are one thing I will be very wary of in terms of judging the management. When it comes to business or the quality of business, I think first thing one has to establish is basically the opportunity set. How big is the opportunity, whether the opportunity set itself is growing or not. And secondly, then how the competitive dynamics is playing out in that sector. Like in India, banking or finance is a huge sector and it's continuously growing. But obviously there is huge sort of competition as well. So one has to take calls accordingly. So when it comes to business, I think it's about opportunity size, growth of that opportunity, competition, as well as the nature of the business. Some businesses are inherently capex oriented, or they need upfront investments, and these are cyclical. So one has to be, I think, extra careful in terms of when you are going to invest in businesses which are cyclical and require upfront capex investment.
So in terms of, you have had a reasonably long career in fund management. So any incident which you can talk about, which is, you feel this was a very good idea, and one which was something which you learned from that as a mistake. Can you give some example?
So I will start with the mistake. So a couple of years back, there was a failure of one private sector bank, Yes Bank. And I had invested into that bank. Obviously, for initial few years, it did very well, but then the sort of problem started there. But I kept justifying my investment or my sort of holding in that company, just with things like the quality of the book of that bank. A regulator was sort of certifying the quality for some time, and the price has come down meaningfully. So I was sort of justifying my investment, knowing that things are not going right. And I held on to it some time. Fortunately, I could get out of that before the ultimate collapse. But I think that is one mistake that I learned, that one has to be open-minded in terms of when the facts are hitting you, you should be looking at those facts with open mind and should not sort of fall in love of your investment. I think that is very common mistakes investors or even fund managers do many times. So I think that is a big learning, that every fact you have to judge with very open mind without prejudices. In terms of good investment, I think I had a couple of investment which gave me huge returns in entire fund management career. Few stocks I held for almost 10 years, and they were like 15, 20 baggers from 2011 to 20, etc. And there, I mean, both those stocks, I can name probably Bajaj Finance and Sri Cement. I held for like 2011 to 20 type situation, 10 years. And at any point of time, those stocks were called as expensive by the market people, and tracking those companies quarter after quarter, meeting the managements and gathering that confidence that they are doing all right things and the growth visibility was there, and hence I could held on for a decade and the result was fantastic.
So, since you said that, you held on for, 10 years, now what we see is that most of the investors, they don't hold on for too long. So, what would you advise them, apart from patience, because we all know that patience is always very short, right? So how does one investor look at creating a long-term wealth?
I think there is no alternative to patience. We did one analysis on one of the fund I was managing. So that fund has completed 20 years, and 20-year CAGR was some 17 or 18% odd, and only 23 invested stayed invested for entire stretch of 20 years, and they enjoyed that 18% CAGR. Rest of the people were like coming in and going out depending on the market and all those things, and average investors apart from those 23 earn only 7.5% CAGR. Somebody would have earned 10%, somebody would have earned 5%, but the average was 7, while the fund CAGR was 18%. Because I think people look at past 6 months, past 1 year and take decisions. Many of them would have invested in the fund when the fund has done well for 1 year, 3 year, and probably they would have redeemed when the fund sort of fallen in the ranks for again 1 year or 3 year basis. So I think that is a common sort of mistakes investor continues to do. I think disturbing compounding is a sin in terms of wealth creation. If you disturb compounding, then you miss on to the future returns that stock, that investment, whether it's mutual fund or shares, can give you.
A lot of people have FOMO, that they are missing out on this opportunity. Then there is a lot of fear. There is greed. You also have a fear of missing out on certain things. So how do you manage the emotional bias of the fund management activity?
I mean, obviously, fund managers are also human being, and we cannot sort of completely do away with those behavioral aspects. But definitely, with experience and with some guardrails, we can reduce those kind of mistakes in terms of getting into a FOMO or sort of exiting in a panic, etc. We can reduce those kind of mistakes with obviously experience, because over a period, if you have seen the markets of say more than say 10, 12 years, you would have seen probably 2-3 downturns, big downturns, and 2-3 bull markets. And those bull markets and downturns obviously teach lot many things. And other thing is basically guardrails in terms of with sort of experience, we can judge that when there is exuberance in the market, people start extrapolating good sales growth, good margins, and apply very high multiples. I think typically that's the time when they make the mistakes in terms of paying very high for any stock. I think we try to manage or reduce those kind of mistakes, or we try to book profits in those kind of scenarios where extrapolation is rampant in terms of sales growth, margin trajectory, and on top of those things, very high valuations were assigned. That is the time to sort of take money off the table. You might lose the last 10-15%, but don't worry about that, because you are securing at least 40, 50, 80% gains which you already made. So I think that is one. And in terms of panic, always just look at the history again. Like we are just coming out of COVID 4-5 years back. I mean, once in a lifetime kind of scenario. And we have seen market doing exceptionally well after that. And similar kind of things have happened after 2000 Y2K or 2008 Lehman. And I think it always pays to be an optimist in the market. over a long period of time. And particularly in those kind of scenario of incidents of panics, I think it pays doubly to be an optimist. So to some extent, I would say it comes with experience and conditioning of the mind.
Any example of anything which you felt that there was a FOMO of you missing out? Last year we have seen a lot of exuberance in the market. So did you have any FOMO at any point of time?
Fortunately, I have been able to manage the FOMO aspect pretty well in my career. Many times, actually, I made mistakes in terms of maybe exiting early. But in terms of FOMO, I was sort of able to manage. So if you look at last 3 years, there were n number of IPOs which has happened in the Indian market. But I hardly invested in just 3 or 4 of them. Every IPO was sold basically on the basis of FOMO, if you look at in last 3 years. But I stayed away from most of them.
So, we have a lot of pressure on, creating alpha. So do you have the same sort of a pressure, or do you also try to, hug to the benchmark, or you are completely benchmark agnostic?
So I would say creating alpha is always a endeavor. I know there are a lot of expectations from investors, management to create alpha. I would not term it as pressure, so I want to just correct that. And secondly, in terms of benchmark, I am always aware of the benchmark, what is in there and with what kind of weightage is there. But I am not sort of benchmark hugging person. We are active fund managers and we will sort of choose stocks basis our thought process, philosophy and the upside potential, etc., etc. So even in my career previously last 10, 12 years, at many times or maybe most of the time, I was not investing into some of the heavyweights in the index because maybe I had issues with the corporate governance or those groups are too diversified. So I like businesses which are a focus on 1 or 2 businesses and doing well in that business and increasing market share rather than any company trying to do multiple things at a time. So I stayed invested from some of those kind of heavyweights in my career. So yeah, I think it's not necessary that one has to hug benchmark. It can be a safe strategy, but obviously when you are benchmark hugging, there are limitations to create alpha as well. It works exactly opposite because if you're hugging the benchmark, then getting that alpha becomes difficult to that extent.
So one of the things, what we have seen is that, investors are always chasing returns. And what we have seen is that also, winners rotate. Now, given that, in your view, what should the investors be looking at while investing? I mean, return, yes, obviously one of the parameter, but what are the parameters they should look at? Because whatever they are looking at is the past return.
So I think when investors are looking to invest in their individual capacity in shares directly, I think they would be better off or can be better off looking at many B2C companies which sell to customers, end customers, rather than B2B companies which sell to other businesses. By and large, B2B companies are capex oriented or they are cyclical in nature. And when you are getting into those kind of businesses or stocks, you need to time them according to the cycle of that industry or sector. But in many sort of B2C companies which cater to end consumers, and given India's demographic profile of maybe 150 crore people, aspirations and all those things, those companies, at least for extended period of time, can provide a compounding kind of growth. And in those businesses, investors can actually create wealth. And history also suggests the same. So I would say investor would be better off if they're investing on their own to look at more of B2C companies rather than B2B companies.
Okay. And, one is that, you also mentioned that exit is always difficult. Buying is simple, right? And you always have, there's a conundrum that if you sell and the next idea which you buy, that idea goes down and what you sold goes up, right? So how do you handle that dilemma?
Yeah, I think when it comes to profit booking, and I mentioned earlier that in some cases where there is exuberance in the marketplace in terms of extrapolating sales growth, margins, good margins, and assigning high multiple, that is where one has to book profit. Obviously, there is a dilemma of reinvestment, as you mentioned, whether the next investment, when and how I will spot. But fortunately, we are in India and we have n number of opportunities across, say, banking and finance or consumption or exporters or infrastructure. So at any point of time, I mean, there are more than say 5,000 companies listed on stock exchanges, and at any point of time we are tracking ourselves more than 4 to 500 companies in our mutual fund. So at least to me that question has never arisen that if I book profit here, where will I invest? I always could find opportunity. Like Mr. Peter Lynch said, you have to keep sort of turning more stones to get the multi-baggers. So I think that is the constant endeavor, that we have to keep searching for ideas, and there are enough number of ideas if we are doing the work diligently.
And what investment philosophy do you follow? So do you follow a top-down approach or a bottom-up philosophy? I mean, what has been your philosophy in managing the funds?
So even if the top-down theme is very strong, but you are not getting right business or right management in that theme to play, I think it's better leave that theme. One should not be compulsive in terms of investment. There are a lot of opportunities, or one can wait and the next opportunity can come. So I think it's a mix of both top-down and bottom-up, but then one has to get the bottom-up idea to play that theme. Otherwise, one can leave the theme.
Okay. And one investment rule which you would never break.
Obviously, I think when it comes to investment, it's one has to invest where one knows the underlying business or what is buying actually. I think that is the basic rule for any investment. Obviously, at any point of time, we cannot claim to know everything about that business and management, but at least a broad understanding of that industry, business, management, one has to have before investing into that company or a business. Because as I said earlier, it's not a lottery ticket we are buying. We are becoming a part owner in that business. So we have to know something about that company before buying. I think that is the first and most important rule of any investment.
We spoke a lot on your fund management and all. Now, how do you de-stress yourself from whatever you do every day?
I would say blessed with a wonderful family, 2 kids. So that is the place where I can relax. And second, all of us in the family, we enjoy traveling a lot.
So, Atul, some just rapid fire questions for you. Okay. So, mid cap or large cap?
Mid caps.
Warren Buffett or John Bogle?
Warren Buffett.
Alpha or beta?
Alpha.
Active or passive?
Active always.
Value or growth?
Growth always.
Okay. So, thanks. It was really nice having you, Atul. And thank you for joining us on this podcast. Thank you very much.
Thank you so much for watching. If you enjoyed this video, don't forget to hit the like button and subscribe to our channel for more such content. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully before investing.